Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. We are diving deep today into two areas of global finance that are complex, high stakes, and frankly, a bit unnerving right now.
They really are.
Our whole focus here is to cut through that complexity for you, using some recent analysis and data to really understand the structural risks that are flashing red.
That's right. We're going to begin with the multi-trillion-dollar monster that is private credit.
Right.
The immediate concern there is how its rapid expansion, especially bringing in everyday investors, is creating these vulnerabilities around liquidity and really trust.
And then we're going to pivot entirely. We'll look at the surprising shift in the outlook for Chinese equities. I mean, major banks have suddenly become very constructive, but we need to identify the tripwires, things like, extreme trading volume spikes and the stability of the yuan that could derail this whole rally.
Okay, let's start with private credit.
Yeah, let's unpack this market first. For anyone who might not be deep in the weeds of high finance, private credit is basically direct lending.
Right. It's when managers skip the public bond markets and make these bespoke loans directly to companies.
And because these loans are long-term and generally illiquid, they promise higher yields. And boy, have they exploded in size.
They really have. And the problem is that when something grows this fast, when it grows this fast outside of the traditional regulatory sunlight, the first sign of trouble is often a real shock to the system.
And we saw one of those shocks pretty recently.
We did. The incident that really raised institutional eyebrows happened in early 2026, and it involved the giant asset manager Blue Owl Capital.
So tell us what happened there.
So Blue Owl runs these things called non-traded business development companies, or BDCs.
Okay.
Think of a BDC as a company that invests in and lends money to private firms. They're a main vehicle for private credit to reach investors. And analysis shows that when investors rushed for redemptions from one of their BDCs, the firm did something highly unusual.
They allowed investors to withdraw up to 17% of their holdings that quarter, right?
Precisely. 17%. To put that in perspective for you, the standard quarterly limit for redemptions in these things is typically 5%.
5. So they went more than 3 times beyond the standard limit.
Blew right past it.
Now, the management team, they claimed this was investor-friendly. They said, hey, we had the cash, so we let people out. But I have to ask, if everything was fine, why have a 5% rule in the first place and then just shatter it?
That is the structural risk right there.
It's like saying your seatbelt is fine, but you drove into a ditch anyway.
Exactly. When Blue Owl went to 17%, they might have satisfied that immediate demand, but sources confirm it sent a flashing signal of immense underlying redemption pressure to the whole market.
Ah.
In private assets, you see, liquidity isn't just about the size of your cash buffer. It's fundamentally about trust. Trust in the manager's ability to value the assets fairly and get you out without crashing the price.
So breaching that limit suggests that up to 17% of their investors suddenly believed the valuation was wrong, or the exit door was about to slam shut.
That's it.
Yeah.
And this trust issue, it wasn't new.
Oh.
This specific scare was linked to a controversy just months earlier in late 2025. There was a planned merger that raised concerns over a sharp markdown like 20% on asset value.
20%. Ouch.
And restricted withdrawals. So when investors see a potential 20% drop combined with a locked door, they panic. That panic creates the run.
And that panic gets amplified by this massive retailization of private credit. I mean, we are seeing these highly illiquid loans packaged and sold to individual investors and funds and ETFs that look and feel like they should be super easy to trade.
And this is the core danger, the liquidity mismatch. The underlying assets, those private loans, are complex and illiquid. They might take 5 to 7 years to mature.
So you're basically selling a highly specialized antique piece of furniture, which takes forever to sell, but you're selling it through a vending machine that promises instant cash back.
Perfect analogy. The fund structure creates this psychological expectation of easy short-term withdrawal, even though the assets inside are anything but liquid.
And that mismatch is why recent analysis is so worried.
It is. Sources confirm Moody's has been warning about bank-run-like risks since 2025, precisely because of these structures. The history of finance is, it's littered with funds that failed because they promised daily liquidity for illiquid assets.
And the regulators are noticing.
Oh, they're watching. Data shows the SEC is actively scrutinizing these new wrappers. State Street's private credit ETF, for example, faced regulatory concerns right after launch about its liquidity risk management.
So if a wave of redemptions hits like at Blue Owl, what can a manager do?
They have three bad options, really. One, sell the loans at a huge discount, which is a fire sale. Two, restrict redemptions. That's called gating, which just destroys confidence. Or three, do what Blue Owl did and mobilize external liquidity, which just makes everyone ask why they had to.
Every choice makes the panic worse for the next wave of investors.
It's a vicious cycle.
This opacity, this lack of clarity, brings us to that famous quote from JP Morgan's CEO Jamie Dimon about the cockroach theory.
Ah, yes. It's a great analogy for these kinds of markets. The theory suggests that if you see one cockroach in a dark, hidden place, there are probably dozens more you haven't seen.
And applied to private credit.
His warning is all about the market's fundamental opacity. Unlike a public bond, private credit lacks standardized disclosure. And crucially, it's not priced daily. Nobody knows the true value until it sells or defaults.
So the low default rates we hear about might just be hiding the problem.
They could be. It could just be extend and pretend maneuvers where you just extend the loan term and pretend everything is fine. The risk isn't gone. It's just delayed, hiding under the carpet.
And now we have to add another layer of risk on top of all that, concentration risk.
A huge one.
Recent data shows private credit has become deeply involved in funding the biggest tech boom of our time, the AI infrastructure cycle.
Yes. We're talking massive, multi-billion-dollar loans for building data centers all over the world. UBS estimates that AI-related private debt lending has almost doubled in just the last 12 months.
So we've taken an illiquid market structure, private credit, and leveraged it directly to most capital-intensive, cyclically sensitive theme out there, which is AI infrastructure.
That's the compounding risk. Sources point out these AI projects carry huge non-financial risks, getting power, permits, land. Then there's rapid technological obsolescence. Today's top chip is tomorrow's paperweight.
So the long-term credit risk is immense.
It is. And if the market overheats and underwriting standards relax, that liquidity stress we discussed could become a systemic feature of the AI boom itself. This is no longer a slow defensive play. It's tied directly to tech volatility.
All right, let's pivot now. Moving from that opaque world of private assets to the very visible markets in the East. After a long period of underperformance, we've seen a really notable shift in sentiment toward Chinese equities.
We have. The consensus is moving toward a kind of moderate optimism, but it's conditional. Sources indicate Morgan Stanley, for example, has a constructive view. They're projecting moderate single-digit gains.
Okay, and for our listeners, when they talk about the CSI 300 index, that tracks the biggest stocks on the Shanghai and Shenzhen exchanges. A moderate target means they see steady growth built on fundamentals.
Exactly. The Morgan Stanley view really emphasizes earnings growth over valuation expansion.
So the companies have to actually make more money, not just get more popular.
That's the idea. It means the rally will be selective. It requires smart stock picking.
But then you have Goldman Sachs, and they're being far more aggressive.
Much more. Sources show Goldman forecasting a substantial 20% rise in MSCI China and the CSI 300 hitting 5,200 by year-end 2026. That's way above the prevailing sentiment.
A target that high implies that not only do earnings have to grow, but investors have to start paying more for every dollar of those earnings.
Right, the market has to expand its valuation multiples. And the primary fuel Goldman is citing is accelerated earnings combined with that massive AI momentum we were just talking about.
But is that AI momentum real in China, or is it just a global narrative creating some noise?
Well, that's the critical debate. For that aggressive Goldman target to work, the analysis shows that AI earnings can't just be hype. They have to spread broadly across the index and translate into verifiable public profits for a wide range of companies.
Okay, so whether you're in the moderate or the aggressive camp, the analysis shows three common factors have to hold up.
Yes. One, investor risk appetite has to be sustained, can't be a one-off thing. Two, those tech and AI earnings have to be real and widespread. And three, the Chinese currency, the yuan, has to avoid any sharp depreciation that scares off foreign capital.
If even one of those wobbles.
The whole rally could turn into a volatility event.
And one signal that risk appetite is definitely back came in early January 2026. A massive, sudden volume surge.
A huge one.
Data shows onshore market trading volume surged to an incredible 2.8 trillion CNY in one day.
2.8 trillion.
For context, that's a 4-month high and way above the 5-year daily average of about 1.13 trillion.
It's an unbelievable amount of momentum money. Sources read this as a strong risk-on signal. It suggests a recovery in sentiment, more leverage, and an influx of short-term traders.
This volume surge is, I mean, it's absolutely the fuel for the rally. It provides the liquidity for prices to move higher, but it's the definition of a double-edged sword.
It is. That same high volume can become the fuel for the correction.
How so?
Well, high trading volumes, margin expansion, these often precede a spike in volatility. The insight for you is to track that volume. If volume stays high but prices stop going up, it signals that the momentum players are getting trapped.
And when all that money starts looking for the exit at once?
It can reverse very quickly into a destructive snapback.
The third crucial factor is the currency, the yuan. Sources confirm that a gradual strengthening, or at least stability, is the base case for the big banks.
That's right. But according to the analysis, for global investors, the absolute value of the yuan is actually less critical than the management of its volatility.
So it's less about whether the car is going 60 or 65, and more about knowing the driver isn't going to suddenly swerve.
That's a great way of putting it, because stability lowers the perceived risk premium. If the yuan is managed predictably, it's cheaper and safer to hedge your currency exposure.
And if it's not?
If the currency becomes unstable, the cost of hedging your capital can become astronomical. It means that even if a Chinese stock's earnings improve by 10%, currency volatility could wipe out all of those gains for an international investor.
So stability is the enabler, volatility is the killer of foreign capital.
Absolutely. So to synthesize all this, private credit risk is now this explosive cocktail. It combines the structural liquidity mismatch from retail investors with huge concentration risk tied directly to the AI cycle. Meanwhile, the rally in China, it needs more than just policy headlines. It needs genuine widespread earnings growth and critically predictable management of the yuan to keep that foreign money flowing in.
So what does this all mean for you? When you're looking at private assets, look beyond the promised coupon rate. You have to understand the redemption rules, the potential for gating, and the reality of their liquidity buffer. For China, track that volume surge, verify that AI themes are becoming real earnings, and watch that the yuan remains stable. Those are the signals.
And here's a provocative thought for you to explore further. We've established that private credit is now the primary funding source for the exponential growth of AI infrastructure. So, could a sudden, localized failure in financial liquidity like the Blue Owl case become such a critical bottleneck that it doesn't just damage investor returns, but actually constrains and slows down the pace of global technological advancement itself?
Don't forget to subscribe and hit that like button.